Hello, everyone. Brandon Moore here with InvestWise Financial, reaching out to you to try to help calm any nerves that are probably you're experiencing with markets and volatility, and hoping that we can come up with a good game plan and some reminders to help make sure that you're doing the best thing for your money. So, welcome to a few minute session. I want to walk you through and remind about the importance of a plan. Right? Keep calm, focus on the plan. Right? We've been waiting and knowing that there's going to be changes in the economic environment along every corner, right? Recently, the biggest change is with the new administration doing new policies and procedures that have left some feeling a bit uncomfortable and others feeling very happy, right? There's a split token. Our job is to help bring the facts and the knowledge, disregarding what political spectrum it is, helping you make a good decision with your money. And I'll tell you, there is good decisions still to be made. There's no reason to panic, and we are here to help guide you through the best decisions for you. Now, I want to remind you of a few different things of why you work with InvestWise Financial and why we plan here, right? Planning is the key focus of what we do, right? The markets are going to do what the market's going to do, but how we respond is how we come out ahead. Now, the first thing that we do, and the biggest aspect of that, is how we react to one decision or the other in our market cycles, right? We know that we're coming off of a phenomenal 2-year period in the market. We've seen crazy growth, which has been really awesome to see. And many of you have loved to see that too, right? We wish it could continue on an ongoing basis of that nature. But we know that that's not efficient and that's not going to happen, right? That's not realistic to think about, right? We're going to have ups and downs from time to time. And if it kept going up the way it was, I would be more concerned, right? We're going to see a restructuring a little bit of the stock market as it comes into the new year, as you're already seeing, because there's been some overweight, what we call, in equities or stocks for that matter. You've probably heard about the 7 big companies in the S&P 500 that you probably know very well, but those have skyrocketed far beyond many of the other companies because of how much money has been facilitated towards them through different innovations like artificial intelligence or other technologies that have been attractive to investors. Now, looking into your future outlook, I wanted to let you know what we've been doing behind the scenes in InvestWise Financial to help you understand why we make decisions we do and how that affects your plan, right? Now, the first thing that we've been doing, let's talk about the portfolios for themselves, right? What is in there and what has changed in the last few months that's helped us be more confident during this a little bit of a fluctuation that we've seen, right? The first thing is we've noticed that those equities being overweight for a long time, specifically in the large cap sector, we need to balance that out between equities and fixed income, right? Fixed income means bonds, right? So we want to make sure that if the risk reward is not worth as much in the stock portion, we shift a little bit of the portfolio, depending on the risk level, over to the bond side. That helps us reduce some of the ups and downs and make sure that we're not along for as big of a ride as if we were just owning all the large big companies out there. Now, that's important to know because in addition to that, we're trimming the fat on those bigger companies, right? That's how we're doing it, saying let's take some of our profits and move them to more a diversified risk level that fits the market environment we're at today. Okay, so that's one thing that we did actually in mid-February, way before some of the market volatility started happening. Now, the second thing, we actually use some of those extra funds in the portfolios to then shift some risk to other types of assets. One of them being commodities. You might have heard that before, like real assets, physical assets, the gold, the silver, the oil, gas, those types of things are set to do fairly well during volatile times, along with some of the administration's endeavors. In addition to that, one of the other areas was global infrastructure. Global infrastructure is about building and creating economies and growing as much as possible with physical assets. And also the administration has mentioned some of those aspects, especially domestically in the US, with building maybe Apple, building some plants to manufacture goods and other companies. So a lot of things have helped us make those decisions to update the portfolios in mid-February to help prepare for volatility, right? So we're ahead of the game on that, making sure that we're thinking about what should come next. Now, we are optimistic long-term about the market, no matter what you say, right? Because market themselves are efficient. They go through cycles, but we need to make sure that we're in the right type of investment for each client that fits their plan, right? So let's talk about the plan. The plan itself is the most important part of your financial situation. You have very little control, as do I, right, about if the S&P 500 is going to go up or down tomorrow. But what we can control is what bucket of money that falls in. So reiterating again, as you're going to hear it, every conversation we always have is what bucket are we talking about? Your now, your soon, or your later? Your now bucket, your safe and liquid money, your income and cash reserves, right? Allows you to not worry about much in a short term, at minimum 6 months to a year, because you have cash available. The medium term bucket, your soon bucket, allows you to be less aggressive than the market, more moderately positioned to conservative, keeping pace with things like inflation, but also not falling behind, like having too much in cash. And then your later bucket, where you're probably seeing the most fluctuations right now, is the long-term growth bucket. Allows you for long-term exposure, but with ideas of diversification, right? And so you have buckets for a reason, and now is an exact time to say, wow, I've had so much growth in my later bucket. Well, I haven't had to touch my now bucket or my soon bucket realistically, because we just have been in a really big bull market the last couple of years. So nothing that's happening outside of some of the political arguments and the trade issues is out of the ordinary, especially coming off a 2-year high. And I want you to be confident in your plan, knowing that everybody who would attend this call is going to have some sort of bucket plan. And we recommend your investments based on knowing what you have in all of those buckets, not just one of them. So again, hopefully that gives you some reminders and some confidence of a lot of our conversations that you're going to be okay. And we're going to guide you through this, and you not have much to worry about because you have a plan. Many people out there are sitting today thinking, wow, I should have maybe done something sooner because I don't know what the next step is. And at least you guys have, if you don't know the next step, you know who to go talk to. Your financial planners, Brandon Moore. So looking at today's market environment, I want to make sure that we're going to be covering a lot of this in your reviews, right? We're going to talk about that in detail and how to make changes to anything necessary based on what goals and things that have changed in your life. But all of this is going to come to an end at some point, meaning we're going to get past this as we do every other time. Like in the last couple of years, we can remind people of things like government shutdowns, or you can remember COVID, right? That was a big one, a lot different than this type of environment, right? So give it some time, let the portfolios work and do what they need to do, and make sure we know what bucket we're referring to. Now, finally, I wanted to remind everybody, and I was going to show a quick visual about how often and not unique it is for markets to go down a reasonable percentage within the year. So there's a couple different studies out there from many different companies, JP Morgan, LPL, UBS, all sorts of different companies. But JP Morgan has a really good visual of what is called the Guide to the Markets, which allows us to visually kind of show over the last 40 plus years how much did the market fluctuate up and down, and where did it end. So let me do a quick visual screen share with you. I think you'll like to see this. Give me 1 second. I might have to hop around some screens here. Right. So hopefully you can see my screen here. I'll zoom in a little bit. But what is this showing is this is showing the S&P 500. And by the way, not all of you are invested in 100% of the S&P 500. If you are, most likely we have some sort of buffer or downside risk control on that helps you not worry nearly as much. Okay. Now, those who don't have any, that they have diversification, right? You have diversification on many asset classes that mean that you don't have all your money in this basket, right? But if you do, let's see what happens over the years. So what this is showing is the gray is where the S&P 500 ended at the end of the year, each year for, since 1980. The red on the bottom, you see, that is the mid-year intra decline, meaning let's look here where it says roughly 87. The S&P ended the year at positive 2%. However, at one point in the year, it was down 34%. Isn't that crazy? Meaning it went from negative 34 to the end of the year being positive 2. Well, that was quite the ride, right? Let's go to more recent times, right? Even the last 2 years where we've seen really positive returns, the markets were down negative 10 in 2023 at one point, but ended positive 24. They were down negative 8 in 2024 at some point, and they ended at positive 23. As of now, we're down negative 5-ish, again, changing day to day, depending on when you're watching this. But we reached a point where we were positive a few percent. And so you can see there's a lot more on the top line here than there is on the bottom line. There's a lot more gray that's ending in the positive than the negative. And so you really have to put in perspective that this is normal, and we need to make sure the number one thing is always that your plan matches your investment goals. And I know, because we meet with you very often, right? Twice a year, coming through, thinking about the pros and cons, sometimes even more. We're there in between as well, that we are trying to make sure that the investments you own are aligned with your goals and values, because that is the only way you can confidently get through those next phases of life and really learn how to enjoy your money. Okay. So I hope this was a nice, let's call it an afternoon coffee chat whenever you're watching this. I want to make sure I'm always here for you, as you know that, and I'm excited for our reviews coming up. If you have any concerns at all beyond what we talk about or what we'll be covering in our reviews, let us know. We're here to help. Give us a ring, and we want to make sure that you're not going to do something that would affect your long-term plan. So thank you all. Enjoy the rest of your day. Get out there and enjoy the sunshine, and we will be seeing you very shortly. Take care.